Not all dividend strategies are built for real-world results. Some sound good on paper, but never deliver enough income to matter. In this video, we're breaking down how to turn $500 a month into $1,000 a month in dividends without touching complicated tech stocks or gambling on risky plays. You'll see the math, the method, and the mindset behind growing your income steadily and sustainably using time-tested sectors and simple habits. This is not a get-rich-quick pitch. It's a practical blueprint for building real cash flow, because when your goal is income that lasts, the right strategy makes all the difference. Part 1. Choosing reliable dividend stocks for steady income growth. Let's start with dividend aristocrats. These are elite companies that have increased their dividends every single year for at least 25 years. We are talking about giants like Coca-Cola, Procter & Gamble, and Johnson & Johnson. These are not just stable. They are battle-tested through recessions, inflation, even global crises. That means consistent rising income you can count on. Then, look at utilities. These are the companies keeping the lights on. Literally. Power, water, and gas providers like Duke Energy offer reliable payouts because demand never stops. Sure, regulation can hit profits, but their cash flows are among the steadiest in the market. Consumer staples are your next anchor. Think toothpaste, snacks, cleaning supplies, the stuff people buy no matter what the economy is doing. Brands like PepsiCo and Colgate-Palmolive not only deliver regular dividends, but they often have pricing power and customer loyalty that keep their earnings strong. But here is the trap to avoid. Ultra-high dividend yields. A 10% yield might look tempting, but it often signals danger. It could mean the company's earnings are collapsing or that the payout is about to be cut. Remember AT&T? That dividend shrink was brutal. And speculative tech? Forget it. These companies reinvest in growth, not dividends. They can spike your portfolio and then crash it. If steady, growing income is your goal, skip the hype. Ready to see how dividend reinvestment supercharges this strategy? That is up next. Part 2. Understanding dividend yield versus dividend growth. Dividend yield tells you how much income a stock pays today. But here is the twist. High yield does not always mean better. In fact, chasing high yields can be dangerous. It often means the stock price has dropped or the payout is at risk. Think of it like picking fruit from a tree. The biggest apple might look juicy, but if the branch is rotten, it will fall. Now flip the script. Dividend growth is about how much that income will increase year after year. Companies like Microsoft or Visa may only yield 1 to 2% now, but they are growing those payouts fast, 10% or more annually in some cases. That means your future income doubles, even triples, while you hold. So, which is better? It depends on your timeline. If you need income today, say, for retirement, higher yield might make sense. But if you are building for the long haul, dividend growth is the engine that turns small payouts into a powerful income stream. Over 10 or 15 years, a growing dividend can easily outpace a high-yield stock that stays flat, or worse, cuts its payout. The smart move? Balance both. Blend reliable payers with solid yield and steady growth. Think Johnson & Johnson plus a company like Lowe's. Not flashy, but they deliver. Next, we will unlock the true power of compounding with dividend reinvestment plans. The snowball that turns $500 a month into something massive. Part 3. Dividend Reinvestment Plans, DRIP, fueling the snowball. Imagine this. You are investing $500 a month into dividend stocks. Over time, your monthly income starts to grow. Not just from your contributions, but from the dividends themselves. How? Through the power of dividend reinvestment plans, or DRIPs. DRIPs automatically reinvest the dividends you earn into purchasing more shares of the same stock. This means each dividend payment buys you additional shares, which then generate their own dividends. It is a compounding cycle that accelerates your income growth over time. Let us break it down with a simple example. Suppose you invest in a stock that yields 3% annually. In the first year, your $500 monthly investments total $6,000. With a 3% yield, you earn $180 in dividends. Instead of taking this as cash, you reinvest it, buying more shares. The next year, you are earning dividends on $6,180, and so on. Over 10 years, this strategy can significantly boost your investment value and income. The beauty of DRIPs is that they are often commission-free and allow for fractional share purchases. This means every dollar of your dividend is put to work, buying as much stock as possible regardless of the share price. But the real magic happens over the long term. As you continue to reinvest dividends and make regular contributions, your investment snowballs. The dividends buy more shares, which generate more dividends, and the cycle continues. Part 4. Setting realistic income goals and timelines. How long will it take to make $1,000 a month in dividends? That question can either motivate you or crush you. The key is setting goals that are realistic and achievable. Let us break it down with simple numbers. Say you invest $500 a month into dividend stocks, yielding an average of 3.5%. After 1 year, you are earning roughly $210 annually, or about $17.50 per month. That does not sound like much, right? But stay with it. By year 5, with reinvested dividends and compounding, you could be earning around $1,400 annually, over $115 per month. By year 10, you are looking at $3,500 to $4,000 per year in passive income, and that number keeps climbing. The real game changer? Dividend growth. If your stocks increase payouts by just 5 to 7% annually, your income starts to grow faster, without you having to invest more each month. So how do you stay motivated during the early years, when the numbers feel small? First, set tiered goals. Aim for your first $10 in monthly dividends, then $50, then $100. Hitting these mini milestones keeps you engaged and shows your progress. Second, visualize your timeline. If your plan says it will take 8 to 10 years to hit $1,000 per month, you know it is a marathon, not a sprint. And that is okay. You are building something durable, not chasing a get-rich-quick scheme. Tracking tools and dividend calculators can help you project your future income, adjust your strategy, and stay focused. This is not guesswork. It is math, consistency, and time. Part 5. Portfolio diversification to manage risk. You have built your dividend portfolio. But here is the question. Is it bulletproof? If all your stocks are in one sector, say utilities, you are exposed. One regulatory change and your income could take a hit. That is why diversification is not just smart, it is essential. Start with consumer staples. These are the everyday essentials: food, beverages, household items. Companies like Procter & Gamble and Coca-Cola have a history of steady dividends, even during economic downturns. They provide a solid foundation for your portfolio. Next, consider healthcare. This sector offers resilience because people need medical care regardless of the economy. Firms like Johnson & Johnson and AbbVie have consistently paid dividends, making them reliable choices. Utilities are another key component. They provide essential services, electricity, water, gas, that people use daily. Companies like Duke Energy and NextEra Energy offer stable dividends, but remember, overexposure here can be risky due to regulatory factors. The goal is to spread your investments across these sectors. This way, if one faces challenges, the others can help maintain your overall income. It is about balance and reducing risk. By diversifying your portfolio across consumer staples, healthcare, and utilities, you create a more resilient income stream. It is not about chasing the highest yield. It is about building a stable, long-term income. Next, we will discuss why reducing frequent trades can preserve your capital and enhance long-term success. Part 6. Reduce frequent trades. You are investing $500 a month, building your dividend portfolio. But are you unknowingly sabotaging your returns with frequent trades? Every time you buy or sell, you may incur transaction fees. These costs, though seemingly small, can accumulate over time, eroding your investment gains. For instance, if each trade costs $5 and you make 10 trades a month, that is $50 monthly money that could have been invested. Moreover, frequent trading can lead to higher taxes. Short-term capital gains from assets held less than a year are typically taxed at higher rates than long-term gains. This means more of your profits go to taxes, reducing your overall returns. Beyond costs, constant trading can disrupt the compounding effect. By frequently moving in and out of positions, you miss out on the benefits of holding investments over time, where dividends are reinvested and gains compound. Emotional decision-making is another pitfall. Reacting to market fluctuations can lead to buying high and selling low, the opposite of a successful strategy. Instead, consider a buy-and-hold approach. This strategy involves selecting quality dividend-paying stocks and holding them long-term, allowing dividends to compound and grow. It reduces transaction costs, is more tax-efficient, and leverages the power of compounding. Part 7. Tracking progress and adjusting your strategy. You have built your dividend portfolio and started investing consistently. But here is the critical question. Are you tracking your progress? Too many investors set and forget, hoping things just work out. That is a recipe for missed opportunities. If you want to hit $1,000 a month in passive income, you need to monitor and adjust along the way. Start with a simple spreadsheet. Track your monthly investments, current dividend yield, and the actual income you receive. You will quickly see what is working and what is not. Maybe one stock's yield is flat, while another is growing fast. This data is gold. Use tools like dividend trackers or portfolio apps to automate this. They can show you your yield on cost, dividend growth rates, and even future income projections. The more clarity you have, the better decisions you make. As your portfolio grows, revisit your holdings. Is each company still growing its dividend? Is the payout ratio sustainable? Are there better options with similar safety but higher growth? Sometimes, adjusting your strategy is as simple as increasing contributions during a market dip. The key is to stay flexible without overreacting. You are not just investing, you are building freedom. If you've made it this far, I've got a free gift to help you supercharge your dividend income. It's my monthly dividend multiplier guide, a simple roadmap showing how to go from $500 a month to $1,000 a month in dividend income, step by step. It even includes a printable tracker to help you stay on pace. Just comment "multiply" on this video. Once we hit 50 comments, I'll unlock the download for everyone. You're now equipped to double your dividend income without chasing risky tech stocks. But what happens when the market takes a dive? In the next video, I'll share proven strategies to safeguard your dividends during market crashes, so your income stays steady no matter what. Stick around to protect what you've built.